Have you ever wished you had that friend? The one who just gets those really dense reports.
Yeah, the one who can just pull out the gold for you.
Exactly.
Yeah.
So you sound totally clued in without wading through all the data yourself. Well, consider us those friends today.
Because that's what this deep dive is all about for you.
Today, we're taking a closer look at a company whose iconic Arm& Hammer logo is probably in your house right now.
Church Dwight Co. Inc. A real American staple, right? Founded way back in 1846. Known for all those household and personal care essentials.
And our mission today is simple. Unpack their latest Q2 2025 earnings report and a recent news release.
Pull out the crucial bits, the surprising facts, basically get you up to speed fast.
Think of it as your shortcut to understanding this consumer goods giant. We'll explore their recent performance, some big strategic shifts.
And how they're navigating, the current economic landscape.
We're looking for those aha moments that make it all click. Ready to dive in.
Let's do it. So, starting with performance, Q2 2025. What's the top line look like?
Well, for the 3 months ending June 30th, their net sales saw a tiny decrease, 0.3%. Came in just over $1.5 billion compared to last year.
Okay, pretty flat then.
Yeah.
In the first half of the year.
Similar story for the first 6 months of 2025. Net sales dipped a little more, about 1.4%, landing near $3 billion.
Right. But those headline numbers, they don't always tell the whole story, do they? What about organic sales?
Exactly. That's where it gets interesting. Organic sales, which, strips out acquisitions, divestitures, currency swings, they actually increased by 0.1% in Q2.
Ah, okay. So the core business, underneath all the noise, is actually growing slightly.
Yeah, and it hit the high end of their own outlook. That suggests some underlying strength, despite that reported dip. Resilience, really.
That is an important distinction. So how did this translate into earnings? What about earnings per share, the EPS?
Reported EPS for Q2 was 78 cents.
Okay.
But the adjusted EPS, which smooths out those one-off items, that came in higher at $D.94.
$D.94, that's actually up 1% from last year, right? And it beat their own forecast.
It did, yeah. They guided for $0.85.
Yeah.
The big difference here between reported and adjusted, mostly charges from exiting some businesses, which I know we'll get into.
Definitely. So what was the CEO's take on all this? Mixed picture, but maybe leaning positive.
Pretty much. He highlighted that their brands are still performing well, gaining share in both dollar terms and volume across most categories.
So the core brands are holding up.
Right. He emphasized their balanced portfolio value and premium stuff, plus their focus on innovation. He thinks that positions them well.
And he mentions seeing improvements through Q2?
Yeah, sequential improvements in category growth, which made them feel more confident about the full-year outlook. It paints a picture of, active management.
Okay, that makes sense. Which is a good segue into unpacking how they're managing things. Let's talk about those financial shifts, maybe starting with gross margin.
Sure. The reported gross margin took a noticeable hit. It dropped 410 basis points.
Wow, 4.1 percentage points, down to 43.0% compared to last year. That's pretty significant. What happened there?
Well, a big piece of it, 200 basis points, came from costs tied to exiting those businesses. Flawless, Spin Brush, and the Waterpik shower heads.
Okay, so a direct result of a strategic decision, not just market forces.
Right. And then another 180 basis points was because some tariff refunds they got last year just didn't happen again this year.
A one-off comparison issue. So if we strip those things out, what does the adjusted gross margin look like? Is it still down that much?
Much less dramatic. The adjusted gross margin decreased by only 40 basis points, down to 45.0%.
Okay, 40 basis points. Still down, but manageable. What's behind that smaller decrease then?
That remaining dip was due to higher manufacturing costs. Labor, commodities, tariffs are still biting, plus some unfavorable price mix and a recall impact.
But presumably some offsets too.
Yeah, partially offset by their productivity programs kicking in and some benefits from the Graphico acquisition they made. It really shows how those one-off things can skew the headline number. Adjusted feels clearer here.
Definitely. Okay, what about spending, marketing, and SG&A?
Marketing expenses went up 3.1% in Q2. Yeah. About $157 million. They said that reflects more investment in brands and new products.
Makes sense. As a percentage of sales.
Up slightly, 30 basis points to 10.4% of net sales.
And SG&A, selling, general, and administrative?
That increased too, by 2.4% to $228.2 million. But a decent chunk of that, $20.6 million, was non-cash impairment costs from those business exits again.
Ah, so tied to the restructuring. What about adjusted SG&A then? Did that also go up?
Actually, no. Adjusted SG&A as a percentage of net sales decreased. It was down 80 basis points to 13.6%.
Interesting. So despite the reported increase, there were some underlying efficiency gains when you remove those exit charges.
Looks like it. They're tightening the belt where they can, it seems.
All right. How did the different parts of the business do, the segments?
All right, consumer domestic. Net sales there were down 1.4% in Q2.
Any particular reason?
Mostly due to declines in Vitafusion gummies and OxiClean stain fighters. But on the flip side, they saw strong growth from Hero acne products and the classic Arm & Hammer liquid detergent and cat litter.
Okay, so some winners and losers within the domestic market. What about internationally?
Consumer international was the strong spot. Net sales up 5.3% in Q2.
Nice. Was that broad-based?
Yeah, pretty much across their international markets. Led again by Hero, their Abrasi mouthwash, and Femfresha. Good to see that global strength.
Definitely diversifies things. And the last one, specialty products, SPD.
SPD net sales decreased 3.0%. But that was mainly because they exited the Megalac and food safety businesses back in 2024.
Right, so if you exclude those divestitures.
The net sales actually increased, mostly thanks to growth in their sodium bicarbonate business. So similar pattern reported down, but underlying growth when you adjust for the portfolio changes.
Okay, so stepping back, why do all these specific numbers and shifts matter to you, our listener?
Well, it's not just a laundry list, right? It shows a company actively managing its portfolio. Yeah. Making tough calls on brands that aren't pulling their weight.
And strategically investing in the high growth spots, it's how they stay competitive in this, constantly changing consumer goods world.
Exactly. They're pruning the bushes to let the strong stuff grow, essentially.
Which leads us perfectly into those strategic plays and what they mean for the future. Let's dig into those business exits you mentioned. Flawless, Spin Brush, Waterpik shower heads.
Right. So effective May 1st, 2025, they announced they're getting out of those businesses entirely by early 2026.
And those weren't tiny businesses, were they? About $170 million in annual sales last year?
Yeah, significant. And this decision led to that $51 million pre-tax charge in Q2. We talked about mostly non-cash stuff like asset impairments and inventory reserves.
So the big takeaway here is portfolio cleanup, right?
Yeah.
Shedding less profitable or maybe non-core assets.
Precisely. Focusing resources. It's a classic move to boost overall profitability and efficiency long-term, even if it means a short-term hit to the numbers.
Bold move, but often necessary. And they're not done looking at the portfolio, are they? What about the vitamin business?
Good point. On August 1st, they announced a strategic review of their entire vitamin business. That includes big names like Vitafusion and Lael Critters.
Why now? Performance issues.
Seems like it. They mentioned declining market share and financial performance, blaming significant competition, especially from private label.
Ah, the private label squeeze. So what are they considering?
Everything, apparently.
Yeah.
Streamlining the supply chain, new joint ventures or partnerships, even potentially selling it off. They expect a decision by the end of 2025.
Okay, so some pruning, some serious evaluation.
Yeah.
But are they planting anything new? Any acquisitions?
Yes. Big news there. On July 16th, they closed the deal to acquire Touchland Holding Corp.
Touchland, the hand sanitizer brand, the ones with the cool packaging.
That's the one.
Yeah.
They described it as the fastest growing brand in the U.S. hand sanitizer category, holding the #2 spot.
Wow, so this is a significant move.
Absolutely. They're calling it their 8th power brand. That's their term for big, growing brands, usually over $100 million in sales. It really highlights their strategy of buying these fast-moving, high-potential brands.
Injecting some new growth. How much did that cost them?
The price tag was $700 million. That includes some stock for the founder over 2 years.
$700 million. And there's an earnout too, right?
Yeah, potentially another $180 million in cash in 2026 if Touchland hits certain sales targets this year. Shows they're willing to pay up for that kind of growth potential.
Okay, so exits, reviews, acquisitions. Busy time. Let's shift to capital allocation. How are they using their cash? Shareholder returns. Liquidity.
Well, in May, they kicked off a $300 million accelerated share repurchase program, an ASR.
So buying back their own stock quickly signals confidence, usually helps EPS.
Exactly. They already got an initial batch of 2.8 million shares. And earlier in the year, back in January, the board approved a 4% dividend increase.
Raising the payout to shareholders?
Yep. The quarterly dividend is now 0.295 per share, or $1.18 annually.
And to support all this activity, the acquisition, the buybacks, what about their financial flexibility, their credit lines?
Good question. On July 17th, they entered into a new credit agreement. They basically expanded their main revolving credit facility from $1.5 billion up to $2.0 billion.
Gives them more breathing room.
And there's even an option to boost it further to $2.75 billion if needed. So, yeah, tremendous flexibility for whatever comes next, more deals, investments, whatever.
Right, building a war chest, essentially.
Yeah.
Now, what about those external factors? Things like tariffs, trade policy. How are they handling those headwinds?
They definitely acknowledge them. Increased supply chain challenges, commodity cost volatility, general economic uncertainty, specifically mentioning the impact of changing U.S. trade policies like those big tariff increases.
Do they quantify the tariff impact?
They do. They're projecting about $60 million in gross tariff costs on a 12-month run rate basis.
Ouch. So what are they doing to fight that?
Taking action on multiple fronts. Shifting production, finding alternative suppliers they specifically mentioned, stopping water pick imports from China to the U.S., also considering price increases and lobbying efforts.
Covering all the bases. And they mentioned a new bill, the...
Yeah, the One Big Beautiful Bill Act, signed July 4th. It apparently makes permanent some parts of the 2017 Tax Cuts and Jobs Act, like 100% bonus depreciation and expensing domestic research costs.
So potentially some tax benefits there to help offset other costs.
Could be. They're still evaluating the impact. But yeah, it shows they're constantly adapting to this really dynamic global picture.
Okay, so putting it all together, what's the path ahead look like? Let's talk outlook and cash flow.
Right, cash flow from operations. For the first 6 months of 2025, it was actually down about $83 million compared to last year, coming in at $416.5 million.
Why the decrease?
Primarily due to an increase in working capital. It sounds like they had lower accounts payable, though cash collections were up. Also, just lower cash earnings overall contributing.
And their cash conversion cycle. How quickly are they turning inventory and sales into cash?
That ticked up just slightly. It was 30 days in Q2 2025 compared to 29 days a year ago. Generally, shorter is better there, so a small step back.
Okay. What about investing and financing cash flows?
Investing was pretty small, about $39.6 million used in the first half, mostly just for capital expenditures, property, plant, equipment.
Standard stuff.
Financing. That was a much bigger outflow, $426.8 million used. That largely reflects the $300 million share buyback we talked about, plus about $145 million in dividend payments.
Right, returning cash to shareholders. So looking ahead now, what's the guidance for the full year 2025?
For the full year, they're expecting reported sales growth between 0 and 2%.
And organic growth?
Same range, 0 to 2%.
Okay. And what about margins for the full year, adjusted gross margin?
Expected to contract by about 60 basis points compared to 2024. Again, blaming tariffs, input costs, unfavorable mix, but partly offset by productivity and those higher margin acquisitions like Touchland.
So margin pressure continues. Marketing spend for the year?
Projected around 11% of sales. So continued investment there.
And the bottom line, adjusted EPS growth.
Also expected to be between 0 and 2% for the full year.
So flat to slightly up growth overall. What about cash generation?
Cash from operations is forecast around $1.05 billion for the year, with capital spending around $130 million.
Okay. Any specific guidance for Q3, the current quarter?
Yes. For Q3, they expect reported and organic sales growth of 1-2%. So slightly better than the first half trend.
Margins.
Margins are expected to be tighter in Q3. Adjusted gross margin contracting by about 100 basis points. Blaming inflation, tariffs again, lower margins from the businesses they're exiting, plus increased marketing.
So that hits the earnings.
It does. Adjusted EPS for Q3 is expected to be $0.72 per share. That would actually be a 9% decrease compared to last year's adjusted Q3 EPS.
Okay, so clearly showing some of the short-term pain from these strategic moves in Q3.
Yeah, it seems like Q3 might be the toughest quarter comparison-wise before things maybe stabilize or improve.
Right. So wrapping things up, we've really unpacked a lot today, haven't we? Navigating this report from Church Dwight, a company whose products are like everywhere.
We really have. We saw them making those decisive moves, shedding assets like Flawless and the Waterpik shower heads to streamline.
While at the same time grabbing new growth engines like Touchland, it's a clear signal about where they want to focus.
And doing all this while juggling those external pressures like tariffs and still making sure to return value to shareholders through dividends and buybacks.
It's quite the balancing act. It really shows how even these huge established companies have to constantly reassess and adapt. They're making calculated bets for the long haul.
Absolutely. What's in your pantry is definitely the end result of a lot of complex strategy behind the scenes.
Which brings us to a final thought for you, the listener.
Yeah, something to chew on. As you look around your home, maybe later today, think about how many of those everyday items are the result of these kinds of deep strategic financial decisions we just talked about.
And maybe think about how, in this world of sticky inflation and shifting trade rules,
Mm.
companies like Church and Dwight will keep innovating. How will they adapt to keep those familiar brands on your shelf?
And maybe even introduce completely new ones you didn't even know you needed. It really makes you appreciate the forces at play, doesn't it? Even for something as simple as baking soda or cat litter.
It definitely does. A lot more going on than meets the eye.